action-packed, jam-packed presentation today as we have the event that we've all been waiting for to get out of the way, or just waiting for it to happen, shall we say, with US elections landing on the 5th of November, which is also bonfire night in the UK, and I'm surprised nobody's made any bad jokes about fireworks and elections and things blowing up, but there you go. For people in the UK, maybe that will resonate, but for others, perhaps not. But yeah, it's a time that comes around every 4 years. It's the US elections. We've been talking a lot about it in the run-up. No doubt we'll continue to talk a lot about it in the coming days and weeks as the results start to trickle through tonight. And who knows, we may have a result tonight, we may not, but we shall see. Let's get started. We've got lots of slides as usual. You can put your questions in the chat and I will review them later. But let's get started and run through what happened last week, what's coming up this week, what things to watch out for post-election, what things to watch out for tonight as the election results come in. We've also got a few ideas, and we've also got a few ideas pulled from some of the investment banks and some hints towards where you can go to find some interesting information. Okay, well, let's start with overnight. Palantir announced their results, as you can see from the slide. They were pretty good. Palantir has obviously been on a rip recently, but the shares are up in the region of 14% overnight as they reported robust earnings. So Palantir beat overnight, somewhat overshadowed, I suppose, by the elections, and although it's not getting as much news as perhaps it would normally have, and the read through to stock markets and AI in general is perhaps going to be muted today, as everyone's on tenterhooks for the election. But for those of you that are invested in Palantir, that's no doubt a positive. I did note a headline somewhere: Paul Tudor Jones has sold out of Palantir and has moved his holding elsewhere. So if Palantir was not overbought yesterday, it certainly will be today. So that's just something to bear in mind. Moving on to look at equities over the last week. I think with earnings season last week, we had 50% of companies reporting. We had most of the Mag 7 reporting over the last couple of weeks, with Tesla the week before. A story of mixed fortunes. I suppose Tesla kicked us off a couple of weeks ago with a big beat. Shares skyrocketed off the back of that. Google was next with an impressive 8 to 10% after hours move on better than expected earnings. But aside from that, it's been a little bit lackluster. The likes of Meta, Microsoft, Apple, while the market took their results on the day in a mixed fashion, some better than others overall over the week. This goes back to Tuesday last week. Over the week, most of those stocks are down. Google managing to keep its head above water, but all of the others have been dragged down, perhaps because of election uncertainty, perhaps because of a little bit of staleness in the AI theme and concerns. There certainly was a theme emerging, or at least a narrative emerging, shall we say, or continuing to be discussed around just the cost of the investment in AI that some of these companies are plowing into it, and the lack of tangible follow-through. I don't think that should be a surprise to anybody, but every time we get earnings and it gets talked about, it gets brought up as a negative, and no doubt the market will forget about it as earnings moves into the background. But that's perhaps one reason why some of these stocks have underperformed. But you can see on here that the broad market, the S&P 500, is down 2% over that period as well. So therefore, perhaps this is just a general risk-off move into the elections this week. Moving on, you can see that taking a bit more of a in-depth look at what was going on under the hood, or under the blanket, as Goldman's might call it. This is just a rundown of sort of thematic baskets that investment banks put together for their institutional clients to invest in. And you can see over 5 days over that period, there's a very clear trend within the AI space of whether it's semiconductors, PC, AI, data centers, pretty much everything down over the last 5 days, contrasting with an incredibly strong year, but a pretty lackluster month going into earnings, so pretty flat. US election themes are mixed, with falls in some of the tariff baskets, but yeah, again, a pretty mixed picture of the last 5 days with US election themes, as one might expect. Given that the polls have been flip-flopping around, we'll look at that a little bit later. Onto commodities, we remarked a couple of weeks ago, or I think it was about a couple of weeks ago, around about here, that silver, this is silver XAG USD, is the ticker for silver, XAU USD is the ticker for gold. Silver had a big outperformance of gold, driven most likely by a short gamma pocket on the Friday close, Friday the 21st. And we remarked that that may make it an interesting short going into the elections if one wanted to hedge against precious metals longs. It's worked reasonably well, and don't think it's necessarily over, but as we can see, that short-term outperformance over gold has disappeared. I do still think that silver is an interesting way to position for any disappointing outcomes from precious metals, but part of the attractiveness of that trade has decreased somewhat, just with silver coming back. Moving on to look at interest rates, broadly flat over the last 5 days, with a little bit of volatility in and around payrolls. Payrolls was reported on Friday, and it came in as a pretty considerable miss, shall we say, with a 12K number when we expected 100,000, a range of 100,000. That's largely been put down to the impact of bad weather. This chart is just showing you workers not at work because of bad weather. That spiked because of the hurricanes. We also had some strike impacts. That's estimated, quite fuzzily estimated, to be about a 41K impact. So maybe the real number was closer to 60. Still weak, weaker than expected. Let's see, that did have an instantaneous impact on interest rates, with yields falling sharply, but they very quickly recovered and came back to pretty much where they were, which is often the case when financial data gets reported. You get a lot, particularly non-farm payrolls. We often see this picture more normally in equities than in interest rates, where you get a big move on the number and then everything sort of settles back to where it was in the first place, which can be makes these data releases very tricky to trade. Moving on to the dollar, pretty much a mixed picture, but still strengthening against some of those emerging market currencies, as the prediction odds still favor a Trump presidency, which would be seen as negative for some of those emerging markets, particularly Mexico and China, where he's likely to enact tariffs. These are the odds, polymarket odds. We remarked before when we looked at this last week that polymarket odds had surged since October for Trump. They took a bit of a hit over the weekend, really post the Madison Square Garden event. So whether that was related to remarks made at that event, or whether it was related to the Iowa poll on Saturday, the Iowa poll also impacted currencies. That's a little bit hard to see on this chart, but this move here, that sharp move down in the dollar, that was the Iowa poll on Saturday that put Harris in the lead. Just to note that was just one poll, albeit by a very respected pollster, but just one poll broadly, in Iowa, Trump is still expected to win. It's neck and neck, but prediction odds have come back in again. These are the top battlegrounds for tonight. These are the states to watch, and this is how Real Clear Politics sees it at the moment. Pretty much too close to call, albeit Trump does seem to be ahead in most. Pennsylvania and Georgia are seen as key, and he is marginally ahead in those states, but no doubt within the margin of polling error. We've seen plenty of polling error over the last few elections, although I don't have a chart, but it does seem like polling error tends to mean reverse. And the last two elections, the polls have overestimated the Democrat chances. So there is an argument being put forward by some people that know what they're talking about, that maybe this time around the polling error might actually be the opposite. It may be overestimating Trump, but we don't have long to wait. That's just the same picture, showing key battleground states, and again just showing maybe a little bit of a drift down for Harris in some of those states. Just over the last few days, this is as at the 4th of November, so it's up to date as can be. But yeah, it is a little bit of a drop off from Harris there in the polling. I think last week Trump was plus 0.4, so his odds have gone up. Well, his odds have stayed the same essentially, but Harris has dropped. So that's how it looks going into tonight in terms of the key battleground states. This is just a recap from Bloomberg of all of those numbers, showing you really same sort of data. The prediction market's still very much going with Trump. The polls have Trump as a very slight lead. This is aggregated polling. So the polls are starting to move in Trump's favor. The prediction markets have been in his favor for quite some time. We'll actually start getting exit polls tonight, though, so that will give us a lot more information. Just for anyone that is thinking of staying up and watching the election and getting excited, because of the way the states announce, we typically will see Trump leading at the start, just because those heavily Republican, the states that typically vote Republican, they tend to announce early. So you'll probably see initially a surge for Trump, but don't read anything into it. It's likely to be well into the morning in UK and European time before we start seeing any real patterns emerge. With that, a lot of speculation that we won't know the results of this election for quite some time because it's so close to call, etc., etc. Goldman's had a slightly different take on that. This is just their views on it. Actually, they think while it may not be called in the sense that the Associated Press will not call a victor, we should actually early in the night, in the US night, so early in our morning in Europe, it is quite likely that we may well have a pretty good idea of at least who's won the presidency. I mean, the Congress, that is likely to take quite a bit longer, but the presidential race, the expectation is we probably will know at some point tomorrow. Part of that is around rule changes on ballot processing. So there's been some changes in some states that allow for faster ballot processing. There's also likely, one of the big issues back in 2020 was a lot of absentee voting because of COVID. So that really did drag things out. We're not expecting to see that this time around. So that's another reason we may get a slightly faster result than we got last time. This was a survey that Goldman's put out to their clients. It's separated, I think, by a month. The most underpriced outcome is still a Democrat divided government. And so you see the cheap versus my expectation, and that's only gone up So I think that reflects maybe the Democrat presidency split Congress is a little bit underpriced by markets, and they're perhaps ignoring the possibility of that given how close the race is. And that leads to the question of, well, what happens when we know? And this is, I've got two different opinions for you here, a little bit more detail. This is from a Goldman's trader. We've talked about it before, a little bit more detail here and some probabilities. S&P up 3% on a red sweep, up 1.5% on a Trump with divided government, but perhaps a short-lived rally. So an initial pop, but then a sell-off as the market starts to worry somewhat about the tariff impact and the fact that, as you can see, more fiscal becomes difficult. The view is that may be offset by treasury yields falling. A particularly bad market outcome would be a Trump with treasury yields march higher, and that's probably where you see S&P up and then it falls, and then that would be likely because the market's pricing in more inflation. And also at this point that Nasdaq will be okay, but it's probably not going to lead the moves. It's more going to happen in financials due to the deregulation, domestic cyclical stocks. Consumers will underperform, so you could use sectors to do that, to look at that. S&P higher, but you do need the 10-year yield not accelerating higher than 20 basis points. Markets will get concerned if if we do get a red sweep, which we won't know tomorrow, of course, remember. Well, more than likely we won't know tomorrow. But if we did the outcome was a red sweep, it's a balancing act between the uncertainty that a Trump presidency brings, with Republican control of the Congress, and also just what the impacts, the trade-off between tariffs and fiscal loosening and the impact on inflation. Goldman's still going for a positive result in the Trump outcome, but we'll see a little bit later that Bank of America disagree with that. Turning to the other potential outcomes, Harris with a Democrat sweep, extremely low probability, virtually no probability, but who knows, it can always be a surprise. Say that it's risk negative, but perhaps there is a feeling of having event risk out of the way. I think this Harris with divided government, going for an S&P down 1.5%, but good outcome for the Nasdaq, particularly for renewables, for anything China related. Defensives will outperform cyclicals, so things like utilities and staples. And while the S&P will likely fall, it's probably going to get bought, because when everyone steps back and looks at it, the US economy is in a particularly good place relative to the rest of the world. The Fed is still cutting interest rates. The Fed are going to cut interest rates this week, no matter what. And with a divided government and a Harris presidency, well, maybe it's just all a bit dull and it's a bit stiff, and we can forget about US politics for a while and focus on the market again. So I do think, while short term, that is probably a negative outcome, longer term, it may well be seen as positive, as we don't have the risk factor of Trump in the White House to contend with. This is just for those that are planning to stay up and watch through the night. These are the key battleground states that we're watching. This is when the polls will close in the US on Eastern Standard Time, and this is the expectation of when most of the votes will be counted. So again, you can see that by midnight Eastern Standard, we've only got 54% in Pennsylvania, which is a key state, so that might rumble on a bit, but A lot of the other ones are mostly done. Some of these other states have been already counting mail-in ballots, and that just speaks to Goldman's view that actually we may well know at some point in the night what direction the presidency is likely to go in. Just remember that there's an embargo on exit polls up until 10 p.m. UK time. So you will not hear anything about exit polls until 11 p.m. in Europe, 10 p.m. in the UK. And then post that point, you're going to start getting exit polls flowing through, which exit polls should be more accurate than the pre-election polls, because they're polling people who have actually voted. Moving on, I won't spend too long on this, but this just reiterates what does well in either Democrats, renewables, healthcare, infrastructure, Republicans, financials, energy, domestic stuff, domestic construction, domestic tech. So I think that's relatively well known by now, but if anyone was wondering what's going to go well, what's not going to go well, that's from Goldman's. One thing that should, that if you're looking for a sort of, no matter what outcome, what should do well over time, there's definitely a view that either candidates should help small businesses in the UK. So that's probably best expressed by Russell 2000, not in the immediate hours and days after the election, but once the smoke is cleared, we may well see small caps outperform. Of course, that is conditional on interest rates not shooting higher, because small companies don't like high interest rates. And this chart is just showing you that as uncertainty falls for small businesses, the small business index, so we could use Russell as a proxy, tends to outperform the S&P. This blue line is just the ratio of the S&P to that small business index, and you can see that has been underperforming for most of this year as uncertainty has gone up for those small companies. So yeah, if there's one winner longer term, it may well be Russell 2000 small companies. Moving on, I'm sure you'll all be aware of this, but the US is running a very large deficit. Inflation is particularly unpopular with voters. Again, no surprise there. And because of that, Michael Hartnett at Bank of America has a slightly different take on things. I'm not going to read through all of this slide, but he sort of puts it as three contrarian pushbacks. So I always like to hear the other side of things, the opposite view, whether you believe it or not, so leave it up to you. But his take on it is that whoever comes in, actually, rather than increasing inflation, may actually seek to reduce inflation. And that is definitely a little bit anti-consensus, and that's just based on that observation of the size of the deficit. So look to reduce the deficit rather than increase it. So this is the consensus view. This is the consensus view is that Harris equals tax hikes and regulation, which is risk off, and Trump is the opposite. His unconventional view is that actually, yes, if there's a red sweep, markets will rip, but very quickly the market's going to price out Fed cuts. And we're going to get concerned about tax cuts, tariffs, immigration controls, all of that inflation stuff. That's going to lead to risk off and stocks. And that would be best played by short small cap. The alternative, if it was Harris, it was actually buy the dip. So this idea that I just talked about, which actually, she's a globalist, it means status quo, tech leadership is unchanged. It's sort of back to focusing on the fundamentals, shall we say, and gets the sideshow, the circus out of the way. And that would be best played by China. He says China tech, but you could just buy FXI. And similarly, and so on and so forth with tariffs, long US dollar. but actually it may be the opposite. So I won't spend too much longer on that. You can watch the replay and read through it yourself. I thought it's just interesting to hear a slightly different point of view. Michael Hartnett, very well respected strategist. He's been doing it for a long time. He's quite well known for having a slightly different take on things. That means he's often wrong, but when he's not, it's significant. So, in terms of positioning, this is just a chart from Goldman's of the amount of risk. You could think of it as the amount of risk their hedge fund clients are taking at this point in advance of an election. So each one of these lines represents an election year. And we can see that at this point in time, and this data is lagged, it only comes out monthly, so that's why there's a white line here and the blue line stops here. But I think you can see that going into this election, hedge funds are taking on much more risk than they were in the past. Read into that what you will. It doesn't necessarily mean they are bullish or otherwise. They typically are market neutral, but they're certainly putting risk on going into the election, and that may lead to volatility. Another thing that might lead to some volatility, you may have seen this chart before, but the top 10 stocks are 40% of the S&P. Somewhat cherry picking here to show, well, yeah, okay, that was the case in the dot-com bust, but a very different time back in 2000 with a lot of loss-making tech companies. That's certainly not the case now. And yes, back in 2020, but the reason the market sold off in 2020 was much more due to COVID. And certainly, I'm sure you would have been quite happy if you had bought this basket back in 2020. But yeah, you may see that chart doing the rounds. But leadership has narrowed, but that's not always a bad thing, particularly if these are solid companies that are continuing to put in solid results. It's not a bad thing necessarily that leadership has narrowed, but it does mean that perhaps the index could move a bit more than normal if there's a big risk-off move and everyone tries to get out of the same stocks at the same time. Perhaps that's why if we look at the open interest on VIX futures, this is the first time since 2018 people are long. Typically, speculative interest in VIX futures is short because people sell it to generate income in the same way that we sell put options to generate income. Leveraged investors sell VIX futures and look to hedge out the risk. So it is significant that that's come back to flat. First time since 2018, so that does cover the last election as well. So yeah, VIX net long is interesting. On the flip side of that, the index, the bond market is pricing in more stress, shall we say, than the VIX, and perhaps that makes sense given the potentially wide range of fiscal outcomes depending on who gets in as president and who wins Congress. We looked at this before. This SDEX is a skew index, skew being the difference between the volatility of put options and the volatility of call options. And when skew goes up, it's because put options are getting more expensive than call options, and that's typically because people are hedging. So while there's a lot of leverage going into this election, people do seem to be quite well hedged. The expected move for this week in the S&P, just using the 1 week straddle, was about 2.4%, which is a lot larger than it has been through most of the year, but it's not really that significant. Back in 2022, when we had a more volatile trading environment, about 2.5% a week was the norm. So there's certainly, there isn't a huge amount priced into the straddle this week. We just saw some of those potential outcomes that would beat that move. So that is quite interesting. People are hedged, but vol is not super expensive. Despite that, looking on the next chart, people have been buying VIX puts, and maybe that makes sense because in post an event, we expect the VIX to fall unless it's a big risk off event. So perhaps a safer way um, to play to have a risk on bet into the elections is to buy a VIX put or something like this, where you do a bear put spread on VIX, just targeting VIX getting back to that sort of 14 zone. I picked a 15-day expiration to show you here, but of course you could do a little bit longer. The volatility of VIX options is also high. That's typically closer to 100, or sometimes it's below 100. So again, if we get the direction right and VIX itself falls, then we would also expect the volatility of those put options to fall, which will give us an extra kicker. Because remember, with a debit spread, we are long volatility if we are above the strikes, but we are short volatility if we are below the strikes. That's one idea we could look at a little bit later, or maybe even tomorrow morning. As a risk-on trade into the elections. You hear a lot about put walls and call walls and gamma and all of that kind of thing. And that's typically, with the point of view of being long gamma, is when market makers are opposing the general direction of the market. So the market is going up and they're selling futures to hedge themselves. The market is falling and they are buying the market to hedge themselves. So it has this insulating effect on the market, long gamma. And we can see from this Goldman's chart that for most of the year, we've been in a pretty decent long gamma position. This was the big sell-off in August, and that's one of the reasons it really snowballed, because market makers did get short gamma for a period of time. But interestingly, post the last expiration, and this tends to change rapidly when we have big option expirations, because a whole bunch of options basically disappear, and it's related to the sort of the very simple way of looking at it is this sort of put and call wall that you'll hear Felix talk about. The likes of Goldman's can compute it in a much more accurate fashion, and their observation is just that it is gone. There is no more long gamma in the S&P market. It's not short. I think the level it flips to short is around 580, 5,850. So I don't know whether that is on SPY, but it's around 580. But that's just a little warning that if we were to get any sort of negative market outcome that sends the S&P down 2-3%, it may snowball a little bit like we saw in August, just because you don't have that backdrop of dealers acting to dampen market moves. We've also got long short equity funds are very long US stocks, so that's another just another flag, and that's sort of shown on this chart as maybe that's another reason why VIX futures are net long. These guys are perhaps using VIX futures to hedge their very long exposure in stocks. That may be one reason VIX futures have gone long. People have been exiting long bond positions, so that's just which is unusual to exit to sell bonds into an event, because typically holding bonds is protective if the market falls, because bond prices tend to go up as equity prices go down. But this is showing you that there is perhaps a perception that we could see a situation where bond yields go up and equity markets go down, which is what happened in 2022, and it's typically extremely painful for people. So interesting to see longs in bonds have been coming off into the election. This is just another trade. If we wanted to play, leverage that flat gamma going into short gamma, just bearing in mind that, as we talked about, the 1 week straddle is high, but certainly compared to bond volatility. VIX is not high. It could certainly go higher. A particularly negative outcome being a too close to call result and social unrest in the US could easily see VIX back up in the 30s. In this little 15-day end of November, November the 20th, you could push that into December if you like, but you can see from here that's got a 700% return potential if VIX spikes, and there's definitely plenty of background microstructure and positioning out there that could snowball into a big sell-off if we get that nasty sort of post-election social unrest, rioting. I don't see this as a scenario of VIX going up here. If Harris wins and it's a split Congress, I think it's much more social unrest, too close to call, and legal challenges and contested election that drags on, that could see VIX higher, or Treasury yields. Perhaps Fed sweep and Treasury yields really spike higher, all interest rate cuts get priced out. That could also be quite negative for the market. Gold is something that we've touched on before. I know people like to trade it, people like to watch it. Goldman's, no pun intended, have been very bullish on gold. And this is just a chart showing that they've used in one of the reports to show that positioning in gold is quite extreme. They're a little bit worried going into the elections, as we sort of talked about. So what they're recommending is to stay long gold, but to sell out of physical gold, and to use short-term leverage structures. So they're suggesting reducing Delta 1, if you like, or outright exposure to gold, and replacing it with these sort of call spreads that we've been looking at before. They're going 3 months, 6 months to play the medium term, and because it carries better, so that means it doesn't decay as quickly. But yeah, quite interesting for a bank that has been so bullish all year on gold. They're shall we say, hedging their bets somewhat, but their view is that you may get a sharp move lower in the metal, in precious metals post the election, and we talked about playing that using silver. And if that is the case, they're still bullish longer term, so they want to have cash on hand to invest, but they don't want to miss a big move higher if there is a positive outcome around sweep. So they're replacing their physical investment with these call spreads that we have been looking at, and that's just that sort of thing. This is a 2-month call spread. You may well want to go a little bit longer. If you want to match the Goldman's trade, you'd probably be looking at June. They talked about 20 delta call spreads. What that means is that you're basically setting your long strike at 20 delta, and then a spread width of $5, I think, is fine. And that's because around 20 delta, we're getting the most uplift. So if we were setting up a strike much closer to the money, it would look a lot more of a sort of linear progression. So to get what they call convexity, traders like to talk about convexity a lot, but all it means is that it's not a straight line. It goes like this or it goes like this. But convexity is nice because a lot of convexity means you can make a little bit of money and then suddenly, boom, you make a lot of money. So it's that sort of exponential payoff that they are recommending, and that's just some trades we've already looked at. So maybe we're ahead of the game there. I won't spend too long on this, but just as a reminder why they are positive long term. They see that the impact of central banks and investors is going to offset the potential drop in speculative length. So yeah, still going for 3,000 by the end of next year, although that seems a lot less bullish than perhaps it did just a while ago, given what gold's done. Yeah, and just noting that gold has decoupled from the way it normally trades. It normally it's normally much more linked to real yields. Remember, real yields are effectively what the yield that you receive for investing in bonds, inflation adjusted. So as that becomes more positive, and this is an inverted chart, so as it goes down, it's becoming more positive. As that yield becomes more positive, the view is that people will prefer to hold something like treasuries than gold, because gold pays you nothing. But that has certainly not been the case over the last wee while, and they ascribe that to the freezing of Russian central bank assets, and that has led to this. That basically central banks have really ramped up their buying of gold, and they just expect that to continue. Or at least if that moderates, that ETFs are going to pick up the pace on that, and I don't disagree with them. So I certainly agree. Into next year, medium term bullish gold, as we discussed before. Yeah, and that's just a chart that it shows you that as we get uncertain periods, you definitely do see investors stock up on gold. So this is just showing different events drove flows into gold, and again, maybe that's why we've been seeing those flows in most recently, and post the event. That's another reason we may see a dip in gold and precious metals as the event risk has passed. So another reason why you might see a little short-term dip before a move higher. Into equity markets, we've covered this before, but a very positive. On average, November, January is a very positive period for equity markets seasonally. This is what's coming up. Nothing really coming up this week apart from the Fed. I mean, there is a whole bunch of data, but it's really, if people can pull themselves away from the election, the thing to watch for the Fed will be the press conference. No doubt that will be to some extent influenced by what happened post-election. And that the thing to watch there will be, if it's a Trump victory, just how hawkish or how on the fence Powell may be, because they will certainly be concerned if it's a Trump victory, and we won't know by the 7th. I expect we won't know whether it's a red sweep or not, but they will no doubt be hedging their bets. They're going to cut 25 basis points regardless, but it's much more about what's happening over the next 2-3 months that the market will be looking for. A whole bunch of earnings coming up this week. We've already had Palantir, a bunch of other stuff. Supermicro report after the close. That will be interesting given the troubles that they've been through. And yeah, there's a bunch of other stuff this week. One thing that I saw that I could point you in the direction of that you might find interesting, actually, well, just in general, this site, Marquee, is Goldman's research hub. A large part of it is paywalled that you can't get to, but there is surprisingly quite a bit of it that is open. And quite often you'll get guys on Substack stealing these ideas and calling them their own and so on and so forth. But yeah, if you want to go to the horse's mouth and see what Goldman's are talking about, Marquee, that's the site to go to. They do from time to time have these tactical trade ideas, particularly into earnings, as you can see. So they're suggesting November 24th, 30.5 calls on TOST, whatever the hell that is. EXPE, November the 24th, 160 calls. So, if you're looking for some tactical trade ideas that are, being put out by an investment bank rather than someone on YouTube, this might be some fertile hunting ground for you. And this might be something we'll dig into in the future. And there's a pile of other stuff on there as well. Some of it may be a little bit impenetrable, but some of it is quite easy to understand. Just finish with this, that in September, Apple's buybacks could have bought Intel. Who would have thunk it 20 years ago? But there you go. That's the way the world is. So we'll finish on that. Apologize for longer than normal presentation today, but I just wanted to get through as much as we could ahead of the elections tonight, so you're as well prepared as you can be.